Welcome to our webinar today. We are really excited to have you all here, and we're going to be presenting on a great topic today. It's called Clear to Close, Purchase Mortgages and the Lending Process for Realtors. And we have a wonderful presenter with us today, Racole Jackson. She is absolutely excellent. She is an attorney. She is one of the top educators on the lending process out there. And I'm going to hand the reins over to her and let you hear a little bit about her from her. So Racole, welcome, and thank you for being here.
Well, thank you so much, Ben, for the opportunity to share this information with our realtor partners. This is we know, a well-needed topic in our discussion in what we're doing currently with buyers. And so again, I'm super excited to have this opportunity to present this information. My name, as you indicated, is Racole Jackson. A little bit about me personally. I am originally from South Florida. I attended the University of Florida, so I always say go Gators, just in case there's any Seminoles in the room. I like to agitate a little bit. I obtained my law degree from Santa Clara University School of Law, where I was the founder of the Real Estate Law Society. Came back home to Miami and obtained my LLM in Real Property Development from the University of Miami School of Law. I am currently a proud licensed Florida real estate sales professional. I actually got my first real estate license in California while in law school. I came back home, I got my license here in Florida, and I'm also a loan originator. And so for all these reasons, a lot of the realtors like to call me Miss Closed and Funded because I genuinely enjoy real estate. By virtue of all of these trainings and certificates and classes that I've sat in, I do enjoy the ability to be the CEO and founder of the Purchase Ready Group. That is a team of real estate professionals who service buyers and sellers in the real estate sales process. We are powered by Capital Federal Credit Union. The realtors on our team have the ability to become mortgage loan originators and originate loans in all 50 states by virtue of our relationship with Capital Federal Credit Union. So we're super excited about that and looking forward to sharing more with you about that at the end of our call today. And finally, I am the founder of Title Experts. And so you can essentially say from soup to nuts, I enjoy real estate and all things concerning that space.
Well, we are really happy to have you here, Racole. And like I said, everyone, she's got a plethora of experience, not just in the legal side, but in all sides and facets of the real estate industry here. So we are really lucky to have her talking to us, and we got a lot that we're going to learn. So we've got a few things that we're going to go over today and just kind of cover. And those four things are going to be, we're going to go into the purchase loan basics, make sure you understand the 101s on it. Then we're going to get into the loan and application underwriting process, make sure you understand what it takes to get to the finish line. We'll also go over how you can work with a loan officer and kind of cultivate a relationship with them and be working in tandem. And then throughout this whole thing, we're going to be helping you use your mortgage knowledge to grow your business. So that's the name of the game. We're trying to help you be better, help you bring more value to your clients. So we got a lot going on here. Like I said, since we got a lot of content, let's go ahead and jump into this. And let's start at looking at some purchase loan basics. So first, Racole, could you start with a review basically of why it's important for real estate agents and consumers to work with loan officers?
Absolutely. So as we know, a home is usually the largest single investment that someone is going to make, right? And so we also know that buyers will require a mortgage to finance their purchase. We know that on average, about 87% of buyers will require a mortgage to finance their purchase of a home. And so for that reason, it is super important for realtors to have at least what we call working knowledge of lending in the loan origination process. I like to say enough to be dangerous, right? And because I always like to say you're top of funnel. You're likely going to be one of the first professionals in the real estate space to have a conversation with the consumer about buying. And so it's important, again, that you at least have some working knowledge of the loan origination process.
I think that makes sense. And like you said, a lot of buyers are going to need a mortgage. So it's important for us as real estate professionals to be able to understand that process, how it works, and keep our ears perked up for the red flags that say, hey, this person needs to talk to someone. And beyond that, we can hinge it on a reason. You said this, Mr. or Mrs. Buyer. So because of that, I think you should talk to someone. It's better than just saying, hey, let's connect you with someone. It brings value to the conversation. You're supporting your reason for it. So I think it's great. to really understand this. Now, I know there's a handful of mortgage professionals out there. So could you elaborate on some of the differences between a loan officer, a mortgage broker, and a direct lender?
Absolutely. So I think a lot of people, unless you're deep in this space or have attended this webinar now, they do not realize that there is a difference between essentially a loan officer and a mortgage broker. And this distinction does make a difference with regards to the loan products oftentimes that the lending professional can offer to a buyer. So for the purpose of our conversation today, a loan officer we should know works for a bank, a credit union, or another mortgage lender, also oftentimes called a direct lender. A direct lender is the entity that provides the actual funding for that mortgage. The loan officer, to understand it clearly, will only offer the loan programs and products that are available from that direct lender, right? As a loan officer. Now, compare that to a mortgage broker. A mortgage broker is an intermediary. They help a buyer connect with various lenders and they seek out the best fit in terms of the borrower's financial situation and needs. One of the ways that I like to describe the difference between a loan officer and a mortgage broker for realtors is if you consider the difference between working as a sales professional, say for example, for DR Horton or Lennar, for a builder, you're going to sell the homes that are available in that community, in that development project, versus as a retail lender, maybe you're with Keller Williams, Real, or any other mortgage broker, real estate brokerage, you're going to show a buyer potentially those homes that DR Horton is building, as well as other resale properties. So essentially, that is a good way to remember the distinction between a loan officer and a mortgage broker. A loan officer is only going to offer those loan products that are available to them through that one lender that they're working with, versus with a mortgage broker, they're going to shop around for you.
Love that. Really appreciate you breaking that down. Now, I know there's a few distinctions with compensation, but could you quickly just kind of go over how a mortgage broker gets paid?
Yeah, so they're also paid on a commission basis as well, similar to realtors. They're going to earn commissions from either the borrower, the lender, or potentially both at closing.
Perfect, perfect. Well, let's switch gears now. That gives us a little bit of just kind of 101 on what we're talking about, why we're talking about it, why it's important. But could you give us now a quick run through of what some of the common loan types out there are?
Absolutely. So as realtors, I'm sure you guys have heard of the whole laundry list. There's an extensive menu of loan options available. I'm sure someone's looking at the list and they're saying, "Oh, what about what do you call it? Bank statement loans. What about I-10 loans? What about doctors loans? What about lawyers loans?" Well, those are definitely loan products. And guys, there's even more than those. But what we want to go over really quickly for you all are the most common product type, loan product type that your buyers are going to qualify for or apply for when they're looking to purchase a home. And so those include generally the Federal Housing Administration loan, or what we call an FHA loan, VA home loans, United States Department of Agriculture loans, and then conventional conforming loans. Those are generally the most common loan product types that buyers are going to pursue.
Perfect. Well, let's dive a little bit deeper now and learn some of the ins and outs of each loan product. So let's start with FHA loans and kind of go over how to qualify for one, maybe some of the pros and cons of this loan option. Can you dive into that for us?
Absolutely. So FHA loans, or again, as they are, that's an acronym for Federal Housing Administration. They are backed by the Federal Housing Administration and offered by FHA approved lenders. The Federal Housing Administration is a U.S. agency that provides mortgage insurance to FHA approved lenders. Now, just a little bit of back history on FHA and the Federal Housing Administration. The Federal Housing Administration was established in 1934. They helped stimulate the U.S. housing market. The underlying idea is that more people would qualify for mortgages to buy homes if lenders were provided with insurance. The FHA is the world's largest mortgage insurers, protecting FHA approved lenders from losses, especially if the buyer or borrower defaults. So because FHA loans are insured, they're generally easier to qualify for than conventional loans, and they have a lower down payment and credit requirements. So for these reasons, if it's if the lenders are being insured and therefore they're making the requirements to qualify for those loans easier, that's why these loans are ideal for first-time home buyers. However, FHA loans are not only for first-time home buyers. That's a very important distinction to make in this regard. The general requirements for an FHA loan, you should know that FHA loans do not have a maximum income limit or credit score. Again, they are ideal for first-time home buyers because they relax those requirements, but there is no maximum. There is no standard that says, oh, you have a 850 credit score, so you cannot apply for an FHA loan. There are no maximums. Now, with regards to credit scores, FHA loans are generally one of the most forgiving loans as it relates to your credit score. FHA applicants can qualify with a credit score of as low as 500. However, understand that lenders are going to set other requirements for credit scores, and most lenders have a minimum credit score limit of at least a 620. You're going to find many that average around 580, but when you're having conversations with your buyers, depending upon their circumstances, they should try to get around a 620 for more favorable lending terms. Now, with that being said, in addition to a less rigid credit score or higher credit score, FHA loans require just a 3.5% down payment if the borrower's credit score is 580 or higher. This is huge. We know that currently affordability is one of our biggest issues right now in the homeownership space. And so the ability to put down just 3.5% is a huge overcome opportunity for buyers, right? Now, again, remember we mentioned that credit scores can go down to as low as 500, but in those cases, those borrowers, they obviously present a greater risk for lenders. They're going to be required to put down at least 10%, right? And so this is why we want to encourage our buyers to increase their credit scores if at all possible. Now, FHA loans, you guys probably heard, they do require what's called mortgage insurance. And this is mandatory with FHA loans. So regardless of the down payment amount, these borrowers are going to have to make some form of a payment towards mortgage insurance. Now, borrowers who make a down payment of 10% or more, they will make these mortgage insurance premium payments for just 11 years. Borrowers who make a down payment of less than 10% will make these premium payments for the life of the loan, this mortgage insurance, right? Now, the exact rules vary by lender because remember, you can qualify with the credit score as low as 500, but some lenders have set their lowest score at 580, some have set their lowest score at 620. But generally, typically, a borrower can qualify with a credit score of approximately 580 or higher, a down payment of 3.5%, a debt to income ratio of 43% or less, and of course, they have to show employment history. Now, FHA loans do have a limit. There's a maximum amount that borrowers can take out with this loan type. And they're set by region. So lower cost areas have a lower maximum loan amount. Similarly, higher cost areas have a higher loan limit. Now, what I have for you on the screen is an example of just a couple counties here in Florida and their 2024 FHA loan limits, right? So you see, for example, in Alachua County, a single family home, loan limit for $498,257.
Excellent. Excellent. Well, that was a great breakdown, and I really appreciate kind of showing how those loan limits can slide in a different area. It might change for different people's markets, but it's a good illustration for people to see just how those ranges can, drastically be different depending on where you're at. So
Absolutely.
for agents who are working with veterans, because of how competitive the mortgages can be for them, let's talk about the VA loans and just go over the other two federally funded ones. So could we go over VA loans and also throw in USDA loans as well, and just kind of go through how you did with with FHA loans?
Absolutely. VA loans are a dynamic product. This is a very favorable niche. If any of our realtor partners are working with veterans, maybe they're a veteran themselves, or they're They have a family member that's a veteran. My dad was a veteran. We were able to, our first home was purchased using his benefits, his VA benefits. And so this is a very popular space to have a niche in, again, simply because the government wants to encourage home ownership amongst our veterans community. So the VA home loan is a government loan administered by the Department of Veterans Affairs. It is designed for active duty military members, veterans, and their spouses. Now, similar to FHA loans, the VA has a what they call, you guys should get familiar with this term, we have what they're called guidelines. And so it's essentially a matrix. And so guidelines lay out the requirements to qualify for a particular loan type. And so VA has its guidelines, but then lenders can have what we call overlays where they raise those requirements a little bit. So essentially a 580 median credit score is typically required. Again, this is lender specific. The veteran is going to have to be able to provide their certificate of eligibility to qualify for a VA loan. Also, the debt to income ratio must be equal to or less than 41%. Again, just remember, this is typically, and so we do have in the underwriting process what we call mitigating factors that might allow some wiggle room with some of these requirements, but generally they're looking at about a 41% debt to income ratio. And then VA borrowers will make what we call a one-time VA funding fee to the Department of Veterans Affairs. Now, the reason why VA loans are a tremendous product, and they also are a tremendous niche for realtors to work in, is because of the affordability it creates for veterans. There is no down payment requirement for a VA loan. Again, no down payment. That is huge. Competitive interest rates are provided to VA veterans, but also, even though there is no down payment, there's no private mortgage insurance. So remember the insurance terms we discussed with regard to FHA loans? That is not a requirement for an FHA loan, even though the VA borrower is not making, I'm sorry, for a VA loan, even though the borrower is not making a down payment. So this is huge. Now, the last common form of a government loan is your United States Department of Agriculture, or what we call USDA loan. This is also a government loan, is intended to stimulate the purchase of residential homes in rural areas. Now, I will tell you, even though we say rural, I don't want you to conjure up in your mind the idea of just cow pastures and horses and, and such. It doesn't require that. There's actually a map that shows you some the areas that would qualify for USDA loans. In many areas, it just requires that you push out just a little bit from suburban areas. And so for you, I would encourage you to grab that map and see what areas near you potentially may qualify for USDA loans. Again, similarly to the FHA loans and VA loans, these loans seek to encourage homeownership. And so the requirements are a little bit lessened. And so with income limitations considered, generally these loans also require a lower down payment.
I love that. That's a great breakdown on the federally backed options. And I really like that VA distinction that you talked about with the private mortgage insurance, because I know that can be $100 to $200 a month. So that can add up, over the term of a loan. So that can be a huge area where people can save. And I think that's a great thing to kind of look at. And then the encouragement to look at, just kind of your locality's maps and see where USDA loans might be applicable. That's another great one, because if there's up and coming areas where buyers are moving or willing to move that still have the access that they want, those are great things to have in your back pocket, so that you might be able to suggest a location to them and say, hey, you might want to consider this. This is an area that qualifies. So I love that. So really good insight there. Moving on the next one, let's go to the type of loan type that isn't federally backed. So could you educate us some about conventional loans?
Right. So the next large, what I would call tranche of loans, is your conventional loans. Now, these loans are not backed by a government agency per se. These loans present the most risk for lenders, specifically because the government does not insure them. Now, even though I say most risk, doesn't mean they're like toxic loans. They're not insured, right? And so in the event of a default, they're not going to be covered. They're not going to receive any recovery for their losses in the event of a default. And so this is the reason why we say that they do provide or present some risk to lenders. For this reason, the lenders do extend conventional mortgage to applicants with the stronger financial profile. Now, with regards to interest rate, we talked about how FHA loans, VA loans, USDA loans provide competitive interest rates. The interest rates with conventional loans will depend on the amount of the borrower's down payment, the specific product type that the borrower is applying for, and then of course, market conditions, right? We know that, we are in a different heightened interest rate environment. And so the interest rate that might be quoted to a borrower on a conventional loan today is definitely going to look different than what they would have been quoted back during, for example, COVID. Now, just a quick overview, just to provide a quick reminder of the differences between an FHA loan and a conventional loan, because again, as you're having conversations with buyers, many of them, they might only be familiar with conventional loans and what is required to qualify for a conventional loan, but you'll be able to educate them and say, well, you may not need, a 720 credit score. We can look at FHA loans because those you can qualify with a lower credit score. You will have to make mortgage insurance payments, but again, it gets you into a home. It gets you into building equity right away. The down payment, FHA loans, you can qualify and put down just 3.5%, right? And then the one main difference, you want to talk to your borrower and see what their intended use of the property is. With an FHA loan, it can only be used for a primary residence. With a conventional loan, that loan can be utilized to finance a primary residence, a vacation home, or a rental property. Now, even with that distinction being made, here's a little caveat. Sometimes they call it a hack. If your buyer is purchasing, for example, a duplex, a triplex, or even a fourplex, that will be considered a primary residence if they intend to live in one of the units. But at the same time, they've automatically become what? An investor, a landlord. So that's something that you want to look at when you are conducting your buyer's consultations or having conversations. Ask your buyer, would you be open to a duplex, a triplex, a fourplex? You can qualify with the same FHA loan and immediately begin building equity and becoming an investor.
I love that breakdown and the hack. I mean, saying, hey, how can we maximize your investment while still getting you into, a permanent residence for yourself that it'll qualify under FHA? I think that's such a great distinction to just kind of make a call out to and encourage people to ask about, because that's something that can help your buyers, like you said, get equity, become an investor, and really maximize, that first purchase form. Now, before we move on real quick, in terms of interest rates, is there an advantage or disadvantage with any of these products, or are they all relatively similar with their interest rates?
No, they are not, because again, they all are based on risk.
Okay.
And that risk comes along with, again, the credentials of the borrower, as well as the loan product. So we talked about FHA loans, VA loans, USDA loans being insured, government issued, government backed loans versus conventional loans. They're not insured. Now, there are ways to what we call get these loans off your books, and we're going to talk about that just shortly. But ultimately, there is a difference in the interest rate, again, based upon the borrower's financial scorecard as well as the loan type.
Very good. Good to know. All right, moving on our loans here. In terms of conventional loans, I know there's a big distinction between conforming and non-conforming ones. Can you kind of explain what those mean and kind of what those options are?
Absolutely. So as you mentioned, the distinction between conforming and non-conforming loans is specifically a conforming conventional loan. It meets the dollar limit set by the Federal Housing Finance Agency and the funding criteria of two government sponsored entities called Freddie Mac and Fannie Mae. Now, what this is essentially saying is that the loan is able to be repurchased by Fannie Mae and Freddie Mac. So just to be clear, Fannie Mae and Freddie Mac, they're considered government-sponsored enterprises, or GSEs. You probably heard going around GSEs, and if you didn't hear before, you're going to start hearing it now. These companies were created by Congress to provide liquidity, stability, and affordability to the mortgage market. So similar to FHA, where FHA insures loans, Fannie Mae and Freddie Mac, their primary purpose is to purchase conforming loans on the secondary market. This is how they put money back into the lender's coffers for them to make more loans. They do not insure mortgages themselves. They do not issue mortgages themselves, not Freddie Mac or Fannie Mae. They simply repurchase conforming loans on the secondary market. Now, the conforming loan limit, it changes from year to year. Currently, the conforming loan limit is $766,550 for most parts of the U.S. Similar to what I discussed with you on FHA loans, this loan limit is higher in areas with a higher cost of living. So it does fluctuate, again, based on the region. Now, with regards to non-conforming loans, these mortgages exceed the conforming loan limit, and they're called non-conforming, or what you probably call jumbo mortgages. So we hear jumbo mortgages, you might be a luxury agent, and that's a good thing, right? Because Fannie Mae and Freddie Mac only purchase conforming loans, the demand for non-conforming loans is much less. Let's break this down into more clear English. A jumbo mortgage, a non-conforming mortgage, is not as easy, again, for a lender to get off their books and replenish their coffers. So for that reason, they're not just going around giving out jumbo mortgages, right? They're going to make sure that they're going to be more stringent on the borrowers, again, their credit score, their income, their job history, their reserves, so on and so forth. Because again, this may very well be a loan that they're going to have to keep in their books until it's either paid off or refinanced. Now, again, these loans carry a greater risk for the lender. And again, because there is more money involved, and because they're not guaranteed, they're not insured, and they're not repurchased, the lender is going to be very stringent in qualifying a borrower for these loans. But again, if you are having a conversation about jumbo mortgages, you're in a good space. You're probably a luxury, what we call a luxury agent.
Well, I like that kind of breakdown and explaining them real quick before we kind of move into the next kind of portion that we're in. Is there any pros or cons of having a mortgage servicer changed, or is it pretty much, a moot point for most consumers?
So I would love to say it's a moot point, but I can't honestly say that, only because just to be clear, a mortgage servicer, just in case it's unclear, a mortgage servicer has the responsibility of collecting payments, ensuring taxes are paid, ensuring your homeowner's insurance is paid if you have what we call a fully escrowed mortgage payment. And so, and also if you have any questions about your mortgage, you're calling your servicer. Not every servicer is made the same. So there is, all things being equal, you should not have an issue with the servicer, but everyone should know, again, not all servicers are made the same. There have been issues where there's been mistakes made with payments being applied incorrectly or not applied. So that's also something that realtors should know, because they may, hopefully they don't, but you might get a call from a buyer saying, you know what, it's funny you say that, because I literally just got a call from a realtor who sold a home years ago and her mortgage was not applied. The taxes were not being applied to the property properly. That was just on Monday. It's funny you mentioned that.
Hmm.
So it happens. And so with that being said, again, this was worth the cost of you guys' entry today. So if you happen to, I hope that you don't, if you happen to get a call from a buyer that's saying, oh no, my servicer was not, applying my tax payments, you won't be unawares as to what that means and how that happened and who they're talking about, because that's essentially what the servicer must do, or that's their job, is to apply those payments.
That's good
Your
to know.
job never ends.
You're always on the hook.
You're always on call.
Yeah.
You're always on call. They're gonna call you for everything.
Yeah,
For
that's too
everything
funny.
concerning
Well,
that real estate purchase.
I think it kind of boils down to it depends, but if it does change, make sure you confirm that they're doing things, applying taxes, and make that recommendation to your consumer. If they ask you, hey, what's going on here? Maybe give them that pro tip and just say, just make sure nothing changed, make sure everything's going
Yeah,
through correctly.
absolutely.
And
Absolutely.
like everything, it depends on who you're working with. So
It
that,
depends.
yeah, that makes sense.
That's the easy answer. It depends.
Yeah. Well, now that we know kind of the most common loan products, could we go over just some of the loan interest options that consumers can select from and just kind of break those down?
Absolutely. So, it being in the real estate space, I'm sure everyone's probably heard the different fixed rate versus adjustable rate mortgages. So, just for the point of understanding it, for the purpose of our conversation today, it's important to know that a fixed rate mortgage, it has a fixed interest rate for the entire term of the loan. This means that the mortgage is going to carry a constant interest rate the entire lending period. Once that interest rate is locked in, it does not fluctuate with market conditions, right? If you have a 3% interest rate because you got a great deal during COVID, your interest rate is still 3%. Fixed rate mortgages are popular products for borrowers who want to know for sure how much they'll pay each month for their mortgage. Now, one thing I want to point out here, although your borrower's interest rate does not change, so meaning their principal and interest may not change, if they have a fully escrowed mortgage payment, which means it includes principal, interest, taxes, and insurance, that single monthly mortgage payment can change. Unfortunately, it can increase. Unfortunately, it can drastically increase. If the taxes on the property increases, if the cost of homeowners insurance on that property increases, that monthly payment will increase. So, using your point, Ben, pro tip, if your buyer from a previous transaction calls you and says, "What is going on? My mortgage payment was $3,000 when we closed. I just got a notice from my servicer saying my mortgage payment is now $4,000. What is going on?" The first thing you want to tell them to look at is, did your taxes increase? Did your homeowner's insurance increase? Because if you have a fixed rate mortgage, your interest shouldn't have changed and your principal payment shouldn't have changed, right? Now, with an adjustable rate mortgage has an interest rate that adjusts over time based on market conditions. And even in an adjustable rate mortgage, there's different types of adjustable rate, or they call ARMs. You probably heard the term ARM, a 5-1 ARM, so on and so forth. What you should know is when your customers are discussing an ARM, they're discussing a loan, which interest rate could change over time. Now, a nuance, or I wouldn't say necessarily an interest rate type, but a feature of interest rates that are popular. They were more popular maybe about 6 or 9 months ago, but they're still available now. Is the temporary interest rate buy down. These have become common, and they become common to address what I would probably describe as sticker shock, right? Because of where interest rates are right now. The effect of the interest rate buy down, a temporary interest rate buy down, not a permanent interest rate buy down, but a temporary interest rate buy down, is to reduce the monthly payments made on the loan for a specific period of time. It is not going to reduce the interest rate for the life of the loan. That is a permanent interest rate buy down. A very common temporary buy down type is the 3-2-1 buy down. So what does that mean? And this is important for you guys to know, again, as you're advising your customers, because although it's not as popular anymore, it is still an option. So as an example, how does this work? A buyer is approved for a loan with a 7% interest rate. Using seller concessions, the buyer is going to apply that to create what we call a 3-2-1 interest rate buy down impact on their loan. If they apply a 3-2-1 temporary interest rate buy down, it is going to cause the payments to equal to an effective 4% interest rate in year one of their loan. 3-2-1 buy down. The interest rate is brought down 3% in year one, 2% in year two, and 1% in year three. So in year one, the monthly payments is going to equate to what the loan payment would be if it had a 4% interest rate. You see in parentheses, we have it notated as -3. In year two, the monthly payments are going to equal to what would be the case if that loan had a 5% interest rate, because we've deducted 2%. And then in year three, the monthly payments that will be made will be as if the interest rate on that loan is 6%. The idea is that by year 4, interest rates would have come down, and that buyer can refinance into a lower permanent interest rate, a 3-2-1 buy down. Now, it's important to note that the buyer has to qualify at the 7%. So they're qualifying at the 7%. The loan's interest rate, permanent interest rate, is 7%. But what we've done is we've taken seller concessions, i.e., funds from the seller, placed them in escrow, and applied those amounts at a pro rata amount to the borrower's monthly payments, so that their effective payment amount, again, as we indicated before, would look more as if they had a 4% interest rate in year 1, a 5% interest rate in year 2, and a 6% interest rate in year 3.
I love that breakdown. And I really appreciate you going into the 3-2-1s. I feel like there's something that isn't often talked about. I know when I was buying my home just almost a year ago, we actually go into a 3-2-1 in the sense of asking about it and inquiring about it. And I'd never heard about them. So it was interesting learning about them and deciding, does this make sense for me? So it's something that's worth bringing up to your buyers and making sure that
Exactly.
they know to ask these kind of questions. Because if they're not aware of them, the lender might not be bringing them up if they're not asking. So
Absolutely.
it's always,
Absolutely.
yep. So let's make sure we're educating buyers and letting them know what's out there. All right, we're going to shift gears now and get into kind of what this process looks like and how we can get a client to closing. So can you start by giving us kind of a high level breakdown of what the major steps in the process are?
Absolutely. So so now underwriting. So we know about loan products now. Remember I mentioned the guidelines, and this is where we get into underwriting. This is where we get into your lender actually looking at the loan product and applying the guidelines to this transaction to confirm that the transaction will qualify for loan approval. Now, one of the I guess hacks that I like to leave with realtors and even loan officers, depends, or even consumers. Consumers like this a lot because it helps them understand the lending process. Is the 4 major elements of a loan approval, and it's an acronym called IPAC. I love acronyms because I have a lot that I have to remember. So I create acronyms all over the place to remember things. And so the acronym that I want you guys to take with you is IPAC. IPAC. I stands for income of the borrower. P stands for property. A stands for assets. C stands for credit. With all the confusion and conversation and processes that the borrower is going through to be approved for a loan, what a lender is looking at is these 4 major elements. IPAC, the income of the borrower. Does the property appraise and can get clear title for closing? Does the borrower have sufficient assets for their cash to close, or maybe the loan requires a reserve, right? It requires that once the borrower closes, they still have at least 3 months of expenses in an account. That's assets. And then C is credit. So again, everything that we're doing in this underwriting process is to check these 4 boxes. IPAC, income, property, assets, and credit. Now, with that, the major steps in that process is, of course, first the application, taking the borrower's application. Once we, at that application juncture, we're going to issue what's called a pre-approval, right? So let's go back to IPAC. At pre-approval, we're saying, yep, you got sufficient income. Yep, I see cash. I see your bank statements, savings account shows sufficient assets. And yep, you got that credit score, 850. Good job. How'd you do it? Let's talk about that later, right? So that's what a pre-approval is saying. It's saying, you borrower, you're pre-approved. You're good. Now go find a property so that we can put in this IPAC that will qualify for a loan approval, all right? So after we get our pre-approval, they reach out to you. Here's my pre-approval. Let's go shopping. You go under contract. So now that we have the pre-approval of the individual and we have a property, we're submitting that to underwriting. Now, underwriting, again, is going to go look at those 4 elements, those four major elements of the loan approval, and they're going to say, yep, they're good. They made it. Yep, this property's great. We can approve this loan transaction. At that point, you're going to get what's called a conditional approval. And then from there, you'll ultimately receive your clear to close.
Perfect. So looking at each one of those steps, what's some of the critical information that a real estate professional needs to consider or just kind of be aware of as they're going through it?
So first of all, the pre-approval. Let's go back to application. We know that, of course, a buyer can apply for a mortgage after they've chosen a property to purchase. That is not the best course of action. Ideally, a buyer should apply for a mortgage loan and obtain a pre-approval before shopping for a home. Now, while we're on this, I want to make sure that we understand the difference between a pre-approval and a pre-qualification. Going back to IPAC, borrower just simply states that they make $95,000 a year. Borrower just simply states that they have $40,000 in their bank account. Buyer just simply states that they have a 850 credit score. If I don't gather the documents to support that information, then they will get a pre-qualification letter. Based on what you stated, yeah, you qualify to apply. Versus a pre-approval actually says, provide me with your bank statements to show the $40,000. Provide me with your pay stubs to show the income. Oh, and let's pull your credit report so that we can confirm the credit score. With that, we're actually able to provide a pre-approval. And a pre-approval is what we absolutely want, because that is going to give the buyers an edge in a tight housing market, so that sellers will know that the buyer has the funding. They actually have the funding to back up their offer. And then, more importantly to you guys as realtors, it's going to prevent you from prematurely placing a buyer under contract to purchase. There is nothing worse than doing all this work to put a buyer under contract who never could afford it, who never would qualify for a loan to purchase that property. As a general matter, high level, the general documents to submit an application for a loan are generally 30 days of pay stubs, most recent 30 days of pay stubs, your most recent 60 days of bank statements, of course, their driver's license, social security number, tax returns, and maybe even W-2s. And so very high level to initiate a loan application doesn't take much, but this is essentially the documentation that is required for that process. Now, with regards to credit, again, this is a good area for you to have conversations with your borrowers. Again, many think that they must have an 800 or 750 or 760. That's not the case. We talked about various loan product types that do not require a higher credit score. Now, you should know and share this with your borrowers. The lenders are going to look at generally the middle credit score. They're going to take the middle credit score. And if you have, in the case of multiple borrowers, say, for example, a husband and wife, they're going to take the lower middle credit score and apply it to that loan application. So let's say, for example, husband has a 700, 720, and a 740. Wife is a 800, 820, and an 840. She's amazing, right? Women are, right? We have to take the 720 because that is the lower middle credit score of all borrowers, right? And so that is something to educate your customers about as you have a discussion about credit score. Now, the other thing I want to mention with regards to credit score, specifically because we are working with Rental Beast, and of course that assumes that we work with a lot of customers who either may be currently in rentals or going into rentals. There are resources available that allows renters to report their rental histories to increase their credit scores. That's huge. We've seen credit scores increase 100 points, and credit scores, rental histories of going back as far as 10 years. And so make sure you make note of that as you're working with your customers. If they're currently leasing, or if you're taking them, you're working with them to put them into a lease, that they not forget to report their monthly rental payments to increase their credit scores. Now, lastly, remember, we talked about the property. So with the pre-approval, we looked at income, assets, and credit. The last thing we needed was the property. The property, with regards to the property, the lender will require that the property appraises for the appropriate value to satisfy the loan. And then secondly, they have to make sure that the property will qualify for what we call clear title, right? The buyer must receive clear title to the property at closing. Now, one reason why the buyer must receive clear title to the property at closing is because the lender needs to have a policy that is clear, that has clear title. And so one thing to know is at closing in a finance transaction, once the transaction goes to closing, after closing, there's going to be a title insurance policy issue. There's going to be a policy issue to the buyer, and there's going to be a policy issue to the lender. The policy issue to the buyer is going to ensure their purchase of the home. The policy issue to up to the price that they paid for the home. The policy that's going to be issued to the lender is going to insure them up to the amount that they loaned that borrower. So, for example, if there's a title issue on that property, the lender is at risk of losing their money, right? And so that is the examination that the lender is going to make of that property in order to qualify the property to check all 4 boxes of IPAC. Lastly, once the lender again can approve the income, the property, the asset and credit, they've checked all boxes, the lender will issue the loan approval and then eventually a clear to close.
Awesome. Awesome. I love the distinction on credit scores too. It kind of emphasizes the importance of asking if you've got multiple borrowers, asking what their credit scores are, understanding that there is a difference if one of them is high and one of them is low, that does matter. So it's important to just kind of keep your ears open and just don't say, hey, what are your credit scores? And, you got 2 borrowers and they're like, oh, we have good scores. Well, maybe qualify it and say, what's the range? What are we looking at? Because it does impact, our loan here. So good distinctions to know. So, all right, to wrap this section up before we move into our Q&A, can you go over a few ways that you see successful agents working with mortgage professionals either before, during, or after going under contract?
Absolutely. So now understanding what you know about the loan origination and underwriting process, I will hope that you're going to ask more pointed questions of the lenders that your borrowers are working with. Many of you're going to have buyers come to you and they already have a relationship in place with the lender. They have a pre-approval, hopefully, not a pre-qualification letter. We want a pre-approval. They may already come to you with that, or you may refer them out to some lenders to initiate that pre-approval process. You want to make sure if a buyer approaches you with a pre-approval letter, of course, in addition to getting on the phone and introducing yourselves to that lender to let them know, you're the realtor that they'll be working with, just ask some questions about their pre-approval letter. Did you actually collect their pay stubs, their bank statements? Did you pull their credit? This sounds far-fetched, probably maybe to a few of you, but stranger things have happened, right? You want to make sure that the lender has actually received that documentation and reviewed it. You also want to ask the lender, how soon can they close? There's a difference between what do we call it, a loan officer's pre-approval versus an underwriter's pre-approval. An underwriter's pre-approval can likely get you to closing sooner than a loan officer's pre-approval. What do you mean by that? If an underwriter issues that pre-approval, they have very well already checked off income, assets, and credit. They're only waiting for the property. They're only waiting for you to get that buyer under contract. And if all they're waiting for is to get the buyer under contract, what does that leave for the underwriting process? That's just title and appraisal, maybe a survey. So if that is the case, you have a underwriter's pre-approval, you could possibly close in 2 weeks. So, hey, lender, how soon can we close? Can we close in 2 weeks? Because that's going to make my buyer's offer look that much better. Another important question you would want to ask, can the buyer consider all property types? Depending upon where you're located, here in Florida, we have condominiums. All of our condominium communities will not qualify for every loan type. So we want to ask the lender, can she qualify for, does this loan allow her to purchase a condominium? Right? So you want to know that. I've literally had situations where people have gone under contract for a condominium. They never should have, because that property would not be approved for the loan type. So you want to ask those questions up front. Are there any limitations to be considered on the intended loan type? For example, most common maximum seller concessions. Different loans have different maximum seller concessions. What does that mean? There is a maximum amount of concessions, funds that the seller can contribute to the buyer's purchase. Some loans have a 3% max, some have a 6% max, right? 9. So you want to know before you go out and negotiate for, a 12% seller concession to find out that the buyer can only apply 3% of it, right? So you would like to know that. And then lastly, not as common now, but can the buyer pay more than the appraised value? Of course, this was very common during COVID that buyers would, there were bidding wars and people, buyers were paying 20, 30, $50,000 over appraised value. Is that a situation that we can consider here? That is a question that you would like to ask the lender before going under contract. Now, once you go under contract, you don't just throw caution to the wind, throw the contract in the title and say, call me at, when it's time to close. No, 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 no. It is important. It is absolutely important, realtors, that you stay in communication with the lender. Most importantly, when you're first starting out, do you have everything that you need? Do you have the documentation that you need? Are you hearing from title? Is title getting you the information that you need? Because at all costs, what do we want to ensure? We want to ensure that the lender is ready to close, if not before time, on time. And so you want to remain in communication with the lender with regards to that. And then also, lastly, depending upon your purchase and sale contract, some purchase and sale contracts have default provisions that if the buyer does not meet certain requirements, such as a loan approval by a particular date, then their escrow deposit is at risk. And so any of the responsibilities either that you have or that the buyer has that's tied to that lender, you want to make sure that you calendar them and that you keep in contact with the lender to ensure that those deadlines and requirements are met, right? Because they're likely just working in silos. They're just underwriting. They're just income, property, assets, and credit. But you're watching the contract deadlines and timelines.
I love that. Well, we covered a lot of information here, a lot of good content. So let's get into just kind of the application steps here. And could you go over a few ways real quick for how people can deploy this information to grow their business and kind of next steps for them?
Absolutely, absolutely. So one of the things I always charge realtors with, now that you have this information, you're armed with this, market the money. Many buyers have not moved off the fence because they don't know about loan products. They don't know about a 3-2-1 buy down. Right, affordability is an issue. I don't know about the down payment assistance programs that are available. We didn't even get a chance to cover that. That's a training all by itself to get into more loan products and down payment assistance. But if you get the message out there, I assure you the phones will start ringing, right? It's similar to when you go to stores. You say, oh, buy one, get one free. You're talking money. Oh, this is on sale. We're talking money. You're telling me that I can make a real estate investment and afford it. And so one of the main things that I want to encourage you guys to do based upon the information that you gathered today and that you're going to continue to gather once we leave this place is make sure you take what you've learned to create customers. I assure you that as soon as you tell a buyer, hey, you can qualify for, or you can add a borrower. Your credit score might be 620. Can you add a borrower that has the 720? Right? Or can you add other borrowers, or can you add additional income? Right? Can we make them the primary? So all the things that you've learned, can you take that and encourage more buyers again to get off the fence? Now, this information, how do we get it out? Post it to social media, promote it through text messages, share it through emails, YouTube. You might have a YouTube channel. You might do home buyer workshops, sponsor a classroom, right, at a local school, sponsor a local clinic, right? Sponsor, maybe you have a VA center near you. Wherever you can go and you be the source of information, i.e. education sales. If you can educate prospective buyers on, again, how they can afford to purchase, even in this market, there are people that are still closing. We don't have to just sit on our hands and say, oh, no one can afford it. There's no more homes. Yes, there are. And it's simply information. So information changes situations. So again, take what you've learned, take something and the last thing I'll say is that don't take for granted information that is groundbreaking to consumers. Because we operate in this real estate space, we just assume everyone knows about an FHA loan with 3.5% down. We just assume that. You didn't know that? We just assume that every VA, every veteran knows that they can purchase a home with no money down. We just assume that. But you'll be surprised how many do not know. So take absolutely every bit of what you learned today, break it into bite-sized pieces, and start dripping it into your target audience.
I love it. Lots of great information. We're going to get into our questions and answers now. I know a lot of y'all have some. I've seen some trickling in, but we also, real quick before we start the first one, we have another webinar on Thursday. It's going to go over how to apply this to your business and create a pre-approved buyer funnel. If you get
Absolutely.
registered for it, go ahead and scan that QR code, get registered. And while we're answering questions, make sure you're getting, ready for that webinar and registered for it. So we had one question on loan officer and broker, and someone said, which is the best option for a buyer, or is there one?
Oh, dicey. It depends. I got to give you the attorney answer. It depends. So again, this is what I'm going to tell you. I'm going to take you back to the content and I'm going to say to you, does your buyer need a very exhaustive list or menu of loan products, right? If they need an exhaustive menu of loan products, then a mortgage broker might be the better option for them. If they are an investor, many times a direct lender doesn't have very what we call a cocktail of loan products. So it depends on what the type of loan buyer that you're working with. If they are what we call bread and butter cookie cutter borrower FHA, then they can work with either. Oftentimes I'll tell you that working with a loan officer versus a mortgage broker is going to get them a better rate and also a lower cost loan. A lot of the costs associated with the loan could be less when you work with a loan officer via a direct lender versus a mortgage broker.
That makes sense. It depends. Listen to your client, see what they probably have an appetite for if they get overwhelmed with too many options, and match with the right one. In
Correct.
terms of credit score, someone asked, do you use a FICO 8 for approval?
We do not currently use it for approval. We use the standard FICO scores.
Okay, perfect. I got a question here on what allows an agent to be an MLO and the agent.
Oh, look at that. Now you're really talking my So, short answer, come on Thursday. Literally on Thursday, I'm going to present an opportunity for you guys to jump on a quick, what we call a master class. I'm really going to walk you through what that looks like. Just high level, I'll tell you that working with Capital Federal Credit Union, it has created a very disruptive opportunity for realtors to, again, become mortgage loan originators without having to take the class that I had to take twice because I've been licensed twice, the state exam that I had to take twice, all the fees and the CLEs. And so essentially, it is by virtue of your association with certain lenders. That's the short answer. Your association with certain lenders that allows you to do that on Thursday. You guys make sure that you, my alarm. You guys make sure that you show up on Thursday. We're going to provide you guys with a link to register for a quick, again, like I said, masterclass where you're going to go over that. And literally, it is not a joke. You can collect 2 checks at closing.
I love that. So be here on Thursday. You don't want to miss out. They've got a great offer for us, and you guys will get more information on that. I know we're pushing right up on our limit, but do you have time for 1 to 2 more questions, Racole,
Absolutely.
before
I'm
we head
hanging
off?
out.
All right,
I'm hanging
perfect.
out.
I got one here that just said, are fixed rate mortgages transferable?
What does that mean? Transferable, assumable?
I
That
believe
they might be
assumables. Yeah.
assumable.
If you were selling it, could you transfer or
It
have the
depends
next
on the
buyer?
lender. It
Okay.
depends on the lender. That is a very good question. It depends on the lender. So I
So
guess just to provide clarity, I'm going to assume everyone knows what assumable means. Just it simply means that your new buyer can step into the shoes of the current borrower and continue their long terms. And that's according to the lender, whether or not the lender allows that. That's a very good question.
So, like with some of our answers, it depends. Check with the lender.
Depends on the lender. Yep.
Yep.
But there are assumable loans out there, but it depends on the lender.
Good information to know. I saw this is just a suggestion. I really love it. This person said buy new construction and tell the builders to pay for the 321. I know there's a lot of concessions in new construction. That's a great piece of advice. Dovetailing on this, someone just asked, what would happen in year 4?
Oh, in year 4, we are hoping that the market interest rates will drop, and so the borrower will be able to refinance into a lower interest rate mortgage, right? So we know that currently market interest rates hovering about 7%. The whole purpose behind a temporary buy down is a thought process. You're I don't use the term timing the market, but you're timing the market. You assume that by year 4, again, the interest rate will be lower. So one thing I'll add to that, I'm glad you asked, is that we want to, when we put the buyer in that 7% interest rate mortgage, should you not be able to refinance? Let's say, worst case scenario, interest rates go to 13%. Can you afford 7% once we hit year 4? And if their answer is yes, then we're in a good place. That's a very good question.
Yeah, and like you said, the goal hopefully is that the market is stabilized and you're able to refi, and not have
Right.
to stick in it. But it's a very interesting product, and I also love the new construction suggestion. So a lot of good information on 321s. All right, last one that we're going to have here is could you go over what a DU approval is?
Desktop underwriting, that's an automated system that allows for the loan officer to place that loan application and the supporting documents into an automated underwriting system for the system to spit out whether or not that borrower is approved.
Perfect, perfect. I lied. I got one more. It was a follow-up on the 321, but I think there's two here, and I think they're worth at least diving into. One was, is the 321 the only type? And they say of arm, but I know that this is actually not an arm, so I'll let you talk about it a little bit. And then the other one was, if someone takes advantage of it, what happens if they sell in year 1 or 2?
Oh, good. These okay, LOs. So the first question was, is 321 the only type? No. So there's actually 1 1s, 2 1s, and then the 321. So that's the short answer. And it's the same concept. The interest in a 1 1, the interest rate is reduced by 1% in year 1. 2 1, the interest rate is reduced by 2% in year 1 and then 1% in year 2. And then we went over 321. And then the other question was, what happens if the buyer sells? So I want you to look at it this way: that seller's concession is, again, it is an amount that is collected from the seller at the beginning of the transaction. It is placed in the escrow account. So if the buyer sells in year 1, the balance of that amount that's collected from the seller is going to be applied to their principal balance. So it's going to be less than what they owed. It's a very good question.
So a lot of good information on 321s or other structures of those that you can be talking about with your buyers. But hey, we've gone 5 minutes over. Racole's been really generous with her time, so we definitely appreciate her sticking on here, answering a few more of our questions that you had. Y'all were great to present to. We really appreciate you being here. Big thank you to Racole for presenting this information. And then last shout out, it's on the screen again. If you haven't signed up for Thursday, please sign up for it. We promise you'll have a great time on it. It'll be tons of great information again. And then again, thank you, Racole. We can't wait to see you in about 48 hours.
Oh, there you go. All right,
So,
guys. See you
see
guys on
y'all.
Thursday, and make sure you bring a friend.
Yes, bring a friend, invite anyone you want. So we'll see y'all on Thursday. Thank y'all.